Welcome back to the deep dive. If you've been keeping an eye on big tech news lately, you probably saw the headlines from Meta's Q3 2025 earnings, and they were pretty shocking.
Yeah, that main headline was a real attention grabber. Net income plunging 83% year over year. Just a massive drop.
Exactly, an 83% profit decline when, revenue grew 26%. That usually screams disaster, right? Like a huge fine or some operational meltdown.
It does. It really does. But here's the thing. If you only read that headline, you completely missed what was actually going on under the hood.
And that's what we're here for today. We're doing a deep dive into Meta's earnings report, looking at strategic commentary, and we're even going to run it through a kind of Buffett-style investment lens.
Yep. The mission is to figure out what really caused that profit nosedive. And maybe more importantly, why is Meta betting so aggressively, spending so much on AI in the metaverse right now?
Okay, so prepare yourself for a bit of a financial twist here. Because this story, this huge profit drop, it's actually about future tax savings.
And an accounting choice they made. It wasn't really about operations crumbling. It's a great example of needing to separate the paper figures from the actual business reality.
All right, let's dive into Section 1, this $16 billion accounting shock. Start us off with those raw numbers that first hit the news feeds.
Okay, so the official GAAP net income Meta reported was just $2.71 billion for Q3 2025. Pretty low for them.
And that led to a big EPS cut, right? Like $6.20 per share. That's what caused the 83% plunge everyone reported.
That's the number. But at the same time, revenue jumped 26% to over $51 billion.
Which just doesn't add up on the surface, does it? How can revenue soar while profit basically evaporate?
Well, it points directly to something massive happening outside of day-to-day operations. And in this case, it was a huge one-time non-cash tax charge.
For cash.
Exactly. $15.93 billion. And it was tied directly to new U.S. tax law. The sources we looked at called it the One Big Beautiful Bill Act.
Okay, the tax law impact. This is where it gets a little complex, but it's crucial. This law brought in something called the Corporate Alternative Minimum Tax, the CAMT.
Right. And the CAMT basically says, look, big companies, regardless of deductions, you got to pay at least a 15% tax rate.
So how does that trigger a $16 billion charge, especially when I thought this law actually had some benefits for companies like Meta?
Yes. That's the real head-scratcher initially. The law did allow things Meta wanted, like immediately expensing R&D costs. That's actually expected to save them maybe $15 billion in cash taxes over the next few years.
So they expect to pay less cash, but took a massive paper loss. Why?
It comes down to something called deferred tax assets, or DTAs. Think of these like prepaid tax coupons Meta had saved up based on the old rules.
Okay, future tax credits.
Exactly. But the new CAMT law potentially limits how useful those old coupons might be in the future. If they're going to be forced to pay 15% minimum tax anyway, they might not get the full benefit of those old DTAs.
So accounting rules forced their hand. They had to assume the worst case for those old credits.
Pretty much. Accounting standards made them write down the value of those DTAs now, anticipating they might not fully use them later because of the CAMT floor. It's a non-cash adjustment. No actual money left the building for this $16 billion hit.
Wow. Okay, so if we mentally subtract that $15.93 billion accounting charge, what does the quarter really look like?
Much, much better. If you adjust for that charge, Meta's profit was actually around $18.64 billion.
And compared to last year?
Compared to Q3 2024, their underlying adjusted profit grew about 19% year over year. So the core business was actually quite healthy, thriving even.
So the headline was basically an accounting illusion.
Completely.
Okay, Section 2. Let's talk about that core engine then. Knowing the adjusted profit grew 19% makes sense, given the scale we see. What are the key metrics showing the family of apps is still pumping out cash?
Well, the scale is just mind-boggling, really. Daily active people across Facebook, Instagram, WhatsApp, Messenger hit 3.54 billion.
Billion with a B.
Yeah, every single day. That's up 8% from last year. I mean, that network effect is their huge advantage, their moat.
And they're clearly getting better at making money from those users. Ad impressions were up 14%, and the average price per ad climbed 10%.
And that's what drove that 26% revenue jump.
Yeah.
Ad revenue hit $50 billion. Which is like almost everything, 98% of their total income. It's a phenomenal cash flow generator.
And the profit margin on that.
The family of apps segment pulled in nearly $25 billion in operating profit. That's a really strong 49% operating margin.
Which brings us to the other side of the coin, Reality Labs, the metaverse bet.
Right, the strategic gamble. And it stands in stark contrast.
Give us the numbers for Reality Labs this quarter, the persistent drag, as some call it.
Okay, so Reality Labs revenue was tiny. Just $470 million, less than 1% of total sales.
Okay.
but its operating loss was $4.43 billion.
$4.4 billion lost in 3 months on less than $500 million in sales.
Yep. You're basically spending $10 to make $1 over there. The core ad business is bankrolling a $4.4 billion loss every single quarter for this future bet.
And that really highlights the risks, doesn't it? Even with the core ad engine firing, you've got huge headwinds. Apple's iOS privacy changes are still a factor.
A big one. That was estimated at a $10 billion plus annual hit to revenue at one point.
Plus all the regulatory pressure, especially in Europe with GDPR and the DMA, restricting how they can use data.
Exactly. Which, circles back to why the AI investment is so critical for them. They need AI to work around those data limitations from Apple and regulators to target ads effectively without the old tracking methods.
Okay, Section 3, the AI investment strategy. This feels like the crux of the bull versus bear case right now. They bumped up their spending plans, right?
They did. Management raised the 2025 capital expenditure forecast that's spending on things like servers and buildings to between $70 and $72 billion. That's up from maybe $66, $72 billion previously.
And they explicitly called it an aggressive investment in data centers and AI capacity. $70 billion is a huge number, but isn't everyone in big tech spending like crazy on AI?
They are, but it's the relative scale that stands out for Meta. One analysis we looked at pointed this out quite clearly. They compared infrastructure spending, CapEx plus R&D, to the company's market cap.
Okay, how does Meta stack up?
Meta's CapEx alone is about 4.2% of its market capitalization. That's actually higher than Microsoft at 3.6% or Google at 2.7%.
So relative to its size, Meta is dedicating a bigger slice of its value to building out this infrastructure than even its giant peers.
Exactly. Which leads to this kind of provocative observation from one source about pauper militarism.
Pauper militarism, explain that. Sounds harsh.
It is a bit harsh, yeah. But the idea is that Meta might have a gambler's mentality here. See, the market mostly views Meta as a traditional advertising business. Its value is tied to its price to earnings, its PE ratio. It makes money now.
Right, it's judged on current profits.
But its rivals, or at least parts of them, are playing a different game. Think OpenAI, NVIDIA, maybe parts of Microsoft, Azure focused on AI. They're playing the P-Dream game, price to dream.
Selling the future vision.
Exactly.
Yeah.
Selling this uncertain, potentially massive future growth from AI models, chips, enterprise adoption. And they don't face the same immediate pressure to show exactly how every dollar spent translates into revenue today.
So Meta's stuck. They have this huge, profitable ad business, so they have to justify the $70 billion spend in terms of that business.
That seems to be the tension. How does this enormous AI investment generate new revenue streams beyond just making the existing ad targeting a bit better? If it just defends the current 19% adjusted profit growth, is $70 billion the right price for that defense? Or is it, kind of like running faster just to stay in the same place?
Cannibalizing future potential to prop up the present.
Or at least the market is struggling to see the new thing that justifies that level of spending, unlike with some pure-play AI companies.
Okay, Section 4. Let's connect some dots. Thinking about internal strategy. Let's go back to that $16 billion tax write-off. You said it was optional.
Largely, yes. The timing and approach had some flexibility.
So why choose to take that hit now? Book that really negative headline? Could that signal something about their internal forecasts? Maybe a bit of pessimism?
It's definitely a possibility analysts considered. Choosing to write down those DTAs now might imply that management doesn't see future operating income growing high enough, fast enough, to fully utilize those tax credits anyway.
Meaning they expect to hit that 15% minimum tax rate regardless.
Potentially. If they think they'll hit the CMT floor, then cleaning up the balance sheet now by taking the DTA write-down makes a certain kind of sense, even if it looks bad short-term. It could be seen as implicitly lowering internal growth expectations.
And that aligns with some other, maybe more concrete issues highlighted in the sources. It wasn't just abstract accounting stuff. There were signs of strategic friction, too.
Absolutely. One specific example mentioned was the struggle of a new internal video social product, codenamed WBS. Apparently, it didn't fail because the technology was bad.
So what was the problem?
Poor integration, internal conflicts with the existing very powerful Instagram and Facebook divisions. It's tough to launch a competing product internally when it steps on the toes of your main moneymakers.
Classic big company problem. Any other signs?
There's also mention of some politically sensitive layoffs. Only about 600 AI staff, which is tiny for Meta, but the small number was actually seen negatively by some.
How so?
It suggested management might be hesitant to make deeper cuts needed for efficiency. Perhaps because they're worried about optics or internal morale regarding the big AI push, a sort of tentative move when maybe boldness was needed.
Okay, so we have this picture. A core business that's a cash cow but facing headwinds and internal friction while making massive bets on the future. How does this company look through a strict value investing lens, like the Buffett checklist?
Well, qualitatively, Meta looks fantastic. It really does tick most boxes for a great company.
Like what?
It's an absolute cash machine, positive free cash flow every single year. FCF margins consistently strong, 24–30%. Profitability is excellent, gross margins around 82%, return on equity around 36%. And the balance sheet is a fortress, virtually no debt. Quality-wise, it's top tier.
Okay, great company. But Buffett always says, price is what you pay, value is what you get. Does it pass the valuation test?
And that's where, according to the analysis we reviewed, it fails the strict value investor criteria, at least based on the price around the time of this analysis, roughly $750 per share in late 2024.
What metrics were too high?
The traditional ones. The price-to-earnings ratio was around 24, price-to-book around 8.1. For a strict value approach, those are considered quite high.
And what about discounted cash flow, DCF, trying to estimate intrinsic value?
That showed a significant gap. The DCF models painted a very different picture than the market price.
Give us the numbers. What did the DCF suggest Meta was actually worth per share?
Okay, so the conservative estimate, sort of the baseline intrinsic value, came out around $200 per share.
Wow, okay. Big difference from $750. What about a more standard or nominal case?
The nominal case landed around $380 per share, still way below the market price at the time.
And even if you were super optimistic, assume everything goes right.
Even the most optimistic scenario in the model, assuming really strong, sustained 20% plus growth for years, and flawless execution only pushed the intrinsic value up to about $670 per share.
So wait, the stock was trading at $750, but even the absolute best-case blue sky valuation scenario in this analysis was only $670.
Correct. That means the market price wasn't just reflecting optimism. It was pricing in something beyond even a very bullish, flawless execution scenario.
Which means from a value perspective,
There's basically no margin of safety, as Buffett would call it. You're paying a price that leaves no room for error or unexpected bumps in the road. The analysis concluded the real bargain was back in the 2022 market trough when the stock was down around $90 to $120. That was a true value opportunity.
but at $750, you're paying a significant premium, essentially betting on perfection for years to come.
That's the takeaway from that valuation perspective.
All right, let's wrap this up. Synthesizing our deep dive. Meta's Q3 looked disastrous on the headline profit number, but that was mostly a non-cash tax accounting choice. Underneath, the core ad business showed solid 19% adjusted profit growth.
But the real story, the tension, is this massive, almost unchecked investment in AI and data centers, spending that's proportionally larger than competitors, while the core business still faces those structural risks from Apple, regulators, and the huge ongoing losses from Reality Labs.
Which brings us back to the governance issue, doesn't it? With Mark Zuckerberg holding majority voting control, investors are essentially along for his ride, relying entirely on his vision.
Exactly. His vision delivered the incredibly successful core apps, no doubt, but it's also driving the multi-billion-dollar quarterly burn in Reality Labs. Management definitely regained credibility with the year of efficiency in 2023.
But the Reality Labs losses keep piling up, and at this high valuation.
Yeah, how long can they keep pouring billions into that metaverse bet before shareholders, even without the voting power to force a change, start really questioning that specific allocation? When does the market stop giving the benefit of the doubt?
That's the provocative thought to leave everyone with. How long does that leash extend when the valuation demands near perfect execution? Understanding that shift from a great business at a fair price to one potentially priced beyond perfection. Well, that seems key.
Absolutely. If you're tracking companies making these kinds of huge, potentially transformative bets, continually digging into the valuation details and checking the market temperature is really the only way to stay grounded.